Welcome to Killik & Co.'s podcast for the 1st of July. It is the start of a new quarter, the third quarter for markets and also for the economy. The first half was really dictated by strong first 5-month gains and then giving back at least half of that for most European markets during the course of the next few weeks. And in fact, in Europe, Eurostoxx has actually started to move into negative territory. Saying that, there was a little bit of lighter relief last week, markets managing to sort of claw back some of those losses here in the UK. The starting point today is a quick look at the sort of week ahead, a week that promises lots of action. We are due, as I say, on the 1st of July to see the appointment today, or the starting of Mark Carney, who's going to come in for the Bank of England governor's role. He's got a busy first week because on Thursday, as we can see from this chart, the Bank of England actually will be announcing the first over his tenures, the first interest rate decision. No change expected, but really anticipation that August may prove to be a little bit different in that he may make his mark. He's here just for 5 years, and that doesn't sound, well, sounds long. It's not a long period of time in which to make your mark in that particular role, but make his mark, I'm sure he'll be keen to do. So, as I say, expect little change here in the UK. The ECB also will have decisions from them, and on Friday we have that all-important non-farm payroll data. Important because the jobs market is really the key focus for the Fed in their decisions over QE programs. So looking for how that number turns out. This morning we have had the data from Europe. We talk about the PMI data, very much forward-looking survey, and I can say that where progress was made against expectations was Italy and Spain. Italy's numbers indeed look quite blowout numbers. France was pretty much in line, and Germany just a touch softer than expected. That meant that the euro was trading overall slightly firmer in markets this morning. So let's just take a look at some charts to focus on. We continue to keep a focus on these yields for the 10-year bonds as they have moved and caused waves of action across asset classes throughout the world. And last week saw a pullback in yields from the sort of 2.6, actually 2.65 I think was an intraday high, back to around 2.5 at the moment. What one will argue is that the yields haven't retraced, despite some of the data last week from the US looking below expectations. So the yields remaining pretty firm at the moment up at these levels. In terms of the UK, well, it's a pretty similar picture for the UK, 2.45% at the moment, and holding firm. And really the sort of look across Europe, I would indicate that whilst we saw a brief spike above 5% for Spanish yields, that has retraced very quickly back into the sort of 4.6% region. So any concerns that Europe was going to spiral a little bit out of control on the back of these rising yields in the US has proved to be pretty much short-lived, and of course that's given another boost to risk-on appetite for equities. Currencies, well, in terms of the UK, we did see some revisions down in GDP numbers in the first half, some slightly weaker tone to the UK economic position at the moment, probably coming at a timely moment for Mark Carney as he sort of enters his role of the Bank of England. But currency coming off those highs, there's been an element of dollar strength which is playing to these numbers, but a welcome relief possibly for Mervyn King as he exits that role, that rise to 156, 157 sterling versus the dollar is now back to the 152 region at the moment. In terms of the FTSE, well, as I say, having had that sort of sharp pullback from 6.8 down to pretty close to 6,000, we're now sort of recovering back to about 6,260 at the moment. So put a bit of heart back into in equities over the course of the last week. Now, in terms of the Eurostoxx, I think this is worth highlighting. This is really an amalgamation of most of the sort of European sort of markets, and it was just worth observing that in Europe we were in negative territory. We're just sort of break even as we speak at the moment in Europe, but I want to compare and contrast that to the US, where gains in the US are still in double digit. We've got sort of 12-13% gains being seen in US markets, so really a very sharp difference of opinion over equity performance. between the US and Europe, and really advocating sort of continuing a weighting in US equities at the moment. I'm mentioning gold because the position of gold over the course of the last quarter has been reported by Reuters that it was the worst quarterly performance for gold in at least 45 years. It's looking it could have gone back even further. That number has been a pretty poor performance from gold over that time. What's causing it? Well, literally everything at the moment is working against gold. We're talking about tapering QE, which is supporting monetary policy, that monetary policy isn't getting too far out of hand. We've got generally economic recovery sort of being built into expectations with rising interest rates, and of course it's all of these issues at the moment that are mounting against the gold argument, added to which I suspect in the previous 12 months there was an increasing allocation towards gold as a hedge to uncertainty at the moment, with speculative positions that are beginning to unwind at the moment. So it really culminated in a very sharp downward revision to gold. Clearly the head scratching now is has gold got much further? Comments over the weekend that it could retrace back to $1,000, but all I can see at the moment are indications that mines around the world may not be commissioned or opened with gold at these levels. They become uneconomic, so there may be supply issues coming further down the track which may balance some of the bearish noises around gold at the moment. I suspect that the lion's share of the fall has now taken place. In terms of some stocks that our analysts are highlighting for this week, we're continuing to buy these National Grid. They've sold off very sharply on those rising yields, utility plays, but again over the weekend the Q80 Investment Office talking about investing 5 billion or so into infrastructure plays in the UK. Is not to say they're buying National Grid, but it does show that there is money still around for these annuity style returns. 5.7% dividend yield, and as I say, after that very sharp correction we're continuing to sort of use that as an opportunity to accumulate positions in National Grid. Rather more riskily, but we think that Apple below $400 is again worth another look in terms of timing of product releases. There's talk of a new Apple iPhone, an upgrade to the mini iPad, so nothing revolutionary coming out of Apple, but continuation of the new product enhancements which could well help to the emerging markets. So as I say, back below $400 is obviously a mark in timing call for Apple this week.